Welcome back. Markets are lower this morning. Take a look at futures indicating a decline of 66 points on the Dow Industrials this morning. The S&P's down 7 and the Nasdaq lower by 17. We are all waiting on the talks this week between U.S. and China officials happening on Thursday. Negotiations are expected to resume Thursday, and Beijing is now reportedly ready to talk about a narrowly focused deal with full-scale reform of its industrial sector off the table. In other words, take off intellectual property theft, and let's just talk trade. That's what the Chinese want. Joining us right now is the Vice Chairman and Head of Investment Solutions Group at Bank of America, Keith Banks. Keith, it's always great to see you.
It's good to be here.
How important is this China story for markets and investors? How closely should we be focused on it?
It's very important. I mean, the big three in my mind, Maria, continue to be obviously China, the trade talks. Number one. Number two, earnings, and we're about to embark on third quarter earnings. And number three is the Fed. I mean, those are the three things we got to be laser focused on. They will drive markets both near term and more intermediate term.
Jack?
When you look at what's going on in China and you see obviously all this impeachment talk and all the political rift, at what point do we have a break? What does it take for China to actually, break through and get through that? Is it an election? Can we get something done before 2020 election day?
No, look, it's a great question, and it's the question because it's been going on, and one of you made the point earlier, this has been going on for a long time. I'm not convinced that China is convinced that even if President Trump is out of office, that's necessarily a good thing for China.
No.
If you listen to the commentary from some of the other Democratic candidates, it's pretty aggressive vis-a-vis China. So some people think, well, they're going to wait out Trump, see if he gets out of office. I'm not sure that's the strategy they're pursuing. We'll see what the more recent talks bring. But look, what we're saying at Bank of America is we're not expecting and haven't been expecting a full-blown agreement. We're saying if you can get a truce, that could be enough, because what CEOs need to know is what are the rules of the road for trade. And if they know the rules of the road, whether they're good rules or not as good rule as you would hope for, you know how to plan, and that could also potentially open up the CapEx spigot as well.
So, it's the uncertainty around it.
Yeah, I mean, that's a good point, Keith.
And
handicapping business in China is tough going forward, certainly. And I liked how you did your top three there, because I agree China's first, and then you talked about earnings and the Fed. We talked about this with Mike Lee last hour. The earnings situation here is very interesting to me because we've got negative earnings expectations set up both top line and bottom line. But this is like maybe the kitchen sink quarter, the expectations quarter, where you can just throw it all out there if you're an S&P 5 company because the fact the market's expecting you to.
just blame it all on that.
Why not? What do you think?
Well, what's interesting is we actually think there could be a positive surprise. Everything overshoots, right? You get too optimistic, then you get too pessimistic. Right now, I think the expectation is for earnings to come in for the S&P down around 3%, 2 to 3%. We would not be surprised to see earnings flat or up a little bit. If you get that, if we get another rate cut at the end of this month, and we think you will, and importantly, if the Fed talks about expanding its balance sheet and doing what it needs to do, that's a pretty good combination for markets to potentially move somewhat higher as we go into the very end of the year here during the last quarter.
But the balance sheet expansion, the goal would to not have that be stimulative, but just to prevent problems in the short-term lending market that the Fed has seemed to have fixed in the short run by injecting, basically coming in with facilities on a daily basis. But again, that's not, the Fed Reserve is not looking at expanding the balance sheet to juice the economy. It's just to prevent
some other shocks,
problems in the short-term lending market, in the repurchase market.
Right, but what it will do, though, is it will provide liquidity. It'll provide dollars. That should, along with lower rates, take some pressure off the dollar, which, if that happens again, would be good for U.S. growth. Again, not dramatically, but again, on the margin, and also good for the profits, especially of multinational companies.
We got 40% of revenue.
That's right.
40% of the revenue of the S&P 500 comes from overseas.
Repatriation, dollars screaming.
And for technology companies, it's actually closer, I think, 55%.
And this morning we got the German factory orders out. They were below expectations. Europe's having a really hard time of generating any growth. So from a portfolio standpoint, how do you want to invest, U.S. and the rest of the world? Stocks, fixed income.
So it's interesting. We think we are in the midst of a dual-track economy, which we think can continue for a number of years. What that means is you've got U.S. and China. U.S. driven by consumer, obviously, consumer services, and then you got the China, Europe, especially Germany, driven by the industrial, more cyclical, which has been the weak side. You know, Germany, I think 39% of Germany's GDP comes from exports, 22% from manufacturing, and obviously the U.S. 68% from consumer. The amazing thing about the U.S. consumer, Maria, is that if the U.S. consumer were a standalone entity, it would be the largest economy on the planet.
Yeah.
It's big. U.S. Consumer spending is bigger than the output of China in aggregate.
So you think the consumer takes us through this?
We think the consumer continues to be a very positive thing for the U.S. You've got continued growth in jobs. You've got wages growing, let's call it around 3%. On a real basis, that's significant given where inflation is. So, you know, we are overweight equities versus fixed. We're overweight the U.S. versus the rest of the world. We like large cap, and we think, you know, the shift toward, again, more cyclical stocks will continue, especially if you believe that in the fourth quarter and going into 2020, you can continue to have a reasonable economy and reasonable earnings. And our outlook currently for next year for S&P earnings is about up 6%.
Nice.
Earnings up 6% in 2020.
In 2020.
I like to hear that. That's good, because we're going to need that, I think, after this Q3
Sounds
number.
like, yeah, you're overweight stocks, you're overweight the U.S.
Well,
there you go,
and especially right now with valuation where it is and all the uncertainty, we don't think you can make a case for further expansion of the PE multiple. It's got to be earnings, and that'll be the driver next year.
All right, we'll be watching that for sure. Keith, it's great to get your insights.
Always good to be
As
here.
always. Keith
Thank you.
Banks, Bank of America.